All right, let's talk about Radiant Logistics, ticker RLGT. We just got their latest earnings, and wow, it's a really interesting one. You've got numbers telling you one thing, but the stock's reaction? That's telling a whole different, much messier story. So here's the puzzle, right? Radiant absolutely crushed their earnings estimates, but they came in just a little bit light on revenue, and the stock action was just wild. It jumps up during the day and then completely reverses after the company's call. So what's the real story here? Is this just a great company hitting a few bumps in the road, or is the market sniffing out a bigger problem? That's exactly what we're going to unpack. Okay, so here's how we'll tackle this. We'll start with those mixed signals in the quarter's numbers, then we're going to look under the hood at their M&A engine. It's a huge part of their story. After that, we have to talk about the headwinds they're facing, tariffs and trade stuff. We'll see how that all led to the market's pretty cautious reaction, and then we'll bring it all together for our final take, the next call. All right, let's get right into it with the quarter's report card, and yeah, mixed bag is probably the best way to describe it. The main numbers really did send two totally different messages. And here it is, the core conflict right here. On the one hand, you've got adjusted earnings per share at 11 cents. Now, you have to understand, the street was only looking for 5 cents. That's not just a beat, that's a huge beat. But then you look at the other side, revenue. At $220.6 million, they actually missed what analysts were expecting by about $3.6 million. So you've got this great earnings number, but a slight revenue miss. That's the kind of thing that really gets investors debating. But, if you just zoom out for a second and look past this one quarter to the full fiscal year, well, the picture looks a whole lot better. In fact, it looks pretty strong. Full year revenue up over 12%. And get this, their adjusted EBITDA was up more than 24%. So yeah, there was a tiny revenue miss in one quarter, but the big picture, the annual growth story, it's not just okay, it's really, really solid. And here's what that performance really means in dollars and cents. They expanded their full-year adjusted EBITDA margin by 300 basis points. Now, that's just a fancy way of saying they're becoming way more profitable. This isn't just growth for the sake of growth, it's smart, profitable growth. It's a sign that they're getting more efficient and are doing a great job bringing the companies they buy into the fold. So that kind of begs the question, right? Where's all this profitable growth actually coming from? And that leads us right to the absolute core of the Radiant story, their mergers and acquisitions engine. You could call it their compounder's playbook. And honestly, it's working like a charm. And hey, don't just take my word for it. The founder and CEO, Boone Crane, he said it himself point blank on the earnings call. He said the main reason their profitability improved so much wasn't because the economy was great or anything. Nope. It was because of their very specific, very focused acquisition strategy. So let's see what that strategy actually looks like in practice. Just in fiscal 2025, they were super busy. They did 3 greenfield deals. That means buying companies that weren't already part of their network. They also converted 3 of their existing partners into company-owned locations. And here's a really big one. They bought an 80% stake in a company called Weport, which gives them a major foothold down in Mexico. Okay, so what did all that buying actually do for the bottom line? Well, those deals they made this year alone added $6 million to their adjusted EBITDA. To put that in perspective, that's more than 15% of the total. So this isn't some long-term hope. This strategy is paying off with real hard cash right now. The big question then is, can they keep this going? And if you look at their balance sheet, the answer is a big yes. They've got almost $23 million in cash, and they've only used $20 million out of a $200 million credit line. That's a ton of dry powder to go shopping with. And management made it really clear. The plan is to use that firepower to do more deals. So no, this M&A engine is definitely not running on fumes. Okay, so if the company's internal engine is firing on all cylinders, then why was the market so nervous? Well, that brings us to the stuff they can't control, the external headwinds. We're talking tariffs and all the uncertainty around global trade. And again, the CEO was totally upfront about this. He admitted that they're expecting some choppiness in the near term, and it's tied directly to all the U.S. trade negotiations. This isn't a Radiant problem, it's a huge macro storm that they just have to sail through. And that kind of cautious talk, the market heard it loud and clear. And when the analysts started asking questions on the call, they really dug into these points. You heard about how their clients are just uncertain, and that's making demand really unpredictable. They also talked about how some of their great results from before were because customers were rushing to buy inventory ahead of tariffs. Now, they're just working through all that extra stuff. The one silver lining is that they're seeing business shift away from China and towards places like Mexico where they just made that big investment. But the main takeaway for the immediate future? Management said they're expecting a, quote,
muted peak season. That's not what you want to hear heading into the holidays.
So now we can finally connect all the dots. Let's look at exactly how all these worries about the big picture turned into that really weird and, in the end, negative reaction from the stock market.
I mean, this timeline is just nuts. On the day the earnings came out, the stock actually closed up 5.5%. People saw that big earnings beat and they loved it. But then came the conference call with all the talk about trade and uncertainty, and just like that, in after-hours trading, the stock went negative. By the next morning, it was down over 8%. That's a textbook whipsaw.
And we're not talking about just a handful of people trading. The volume on September 15th was absolutely massive. We're talking more than 7 times its normal daily average. That tells you a real debate was happening in real time. Tons of shares were flying back and forth as investors battled it out. Which story is the right one? The strong M&A growth or the scary macro fears?
So if you had to boil it all down, the market's feeling is constructive, but really cautious. Investors see the great job the company is doing, they see the smart acquisitions, they get that real value is being created here, but they're tapping the brakes because those big external risks, the tariffs, the trade wars, are just too big to ignore right now.
Okay, so that brings us to our final section, the next call. This is where we take everything we've talked about and put it all together into a clear investment thesis and our take on where the stock goes from here. All right, here's our thesis, point by point. First, we think the market is punishing the stock way too much for those macro fears, especially when you see that management isn't just sitting there, they're making moves, like that Weport deal to get ahead of it. Second, it really feels like the market is overlooking the raw power of their M&A engine and how much it's adding to the bottom line. Third, you just can't ignore that balance sheet. It gives them a solid floor and the money to keep growing. And finally, that Weport deal is a super strategic move. It puts them right in the middle of this big trend of companies moving operations to Mexico.
So, what does this all mean for the next quarter? Well, for adjusted EBITDA, we're forecasting it to be flat to maybe slightly up. We think the money from their new acquisitions will probably cancel out the weakness from the broader economy. For the stock itself, we think it's going to be stuck in a range for a while, kind of a tug of war between the good M&A story and the bad trade news. And that all leads us to our rating, market perform. The company is executing beautifully, but those outside forces are probably going to keep a lid on the stock in the short term. So here's the actual trade idea. With the stock having dropped after the earnings call, we think it makes sense to start a small position if you see it dip below 650. This is really a bet on the long game. It's a bet that over the next 12 to 18 months, that powerful value-creating M&A story, that compounder playbook, is going to be what matters most and will win out over all this short-term macro noise.
And just to be perfectly clear, this is for informational purposes only. It is not financial advice.